You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. Today is 5/10/21. Well, our good friend Bob Hoye is back with us now. I heard a rumor, Bob, that you had cornered the market on Dogecoin. Any truth to these rumors?
No, I'm afraid not. That's remarkable stuff going on. Absolutely. And, you start with such crazy prices like 1/4 cent or some damn thing, decimal points. But there may be something very important technically going on in the whole crypto sector. And I think out of it, you're going to end up with a global currency that has more or less constant value and huge liquidity, like a gold-backed dollar. And if it's some kind of a crypto thing, hey, all fine. But what this is a unique financial instrument that is considered new. And at the top of every great bubble in history, there's all kinds of new things to play because promoters have always been promoters and can come up with things that, and what did you see the other day? Goldman going to come up with a special trading desk for cryptos. Now, in the summer of 1929, the rage was like trust companies. Insul created this huge utility empire, and one company was controlling another, so eventually up with a coin. So Goldman came up with a new one that was going to be one of these trusts and would be invested. And by the time they got all the money in September and all organized and ready to go and then was starting to trade, they never did get invested. And then the market crashed. And this stock that they'd created, it's sort of like a closed-end mutual fund, had cash in it only. They never got invested. And then it was trading at a discount. So whoever bought it was getting out, even though it was just all sitting there with cash. So at the climax of a great financial bubble, you can have all kinds of fascinating and weird things going on, but largely it's happened before. In the South Sea bubble in England in 1720, they came out with a company that the story was so good that they couldn't tell anybody what was in it, but you had to buy it. And of course, these are the SPACs nowadays, these things. So anyways, it has been fascinating. And on our work, Kerry, a good call was last October in a slightly depressed market. And in looking at the nature of great financial bubbles, I figured, hey, this thing could rally up to January, and then noted the previous examples of big speculative things running into January. And one was the fabulous Nikkei bubble that peaked on the last trading day of 89. And then there was the even more fabulous speculation in gold and silver that peaked on January 21st, 1980. So I had no idea about this Gamestop thing that came along until it came along and exploded. So we did end up with a speculative burst in a new sector, or a sector where all of a sudden it's there, and that concluded. The stock went from 12 to 480 and then back down. So then the next step was in January, where we'd been watching a way of looking at the outstanding margin on the New York Stock Exchange. And from the previous low to, it gets up to a certain percentage. I can't remember what it was, but it reached that percentage gain in November. And then you take that, and typically, once you've had that percentage gain in outstanding margin, you would look for a peak in the stock market about 6 months later. November, hey, what's May? 6 months later. And then also historically, with the great financial bubbles, the first one was the South Sea bubble in 1720. The fifth one was 1929. And where they occurred in London or Europe, well, they occurred together. But those markets would peak in May or June. Like in 1720 in London, the South Sea stock peaked in late June. Then it dithered around through the summer, and then all of them, Kerry, crashed in the fall. So here we are now, and there's New York, when it became a big enough market to become important, that was with the 1873 bubble. And that action had peaked in London in May, June, and then New York peaked in September. And then again, you move forward to 1929, and same thing happened with New York peaking in September. So this is where we have had, for this year, from the top, the probability of this great bubble concluding in this year. The next level down was that probably by around mid-year. I give myself some room because the speculation in stocks is also accompanied by speculation in commodities, and you can have a high for copper in July, and you can have a high for lumber, and that's been a fabulous one. You can have a high for that in June. So with these seasonals, our view has been sunshine through to around mid-year, and then by August it would change to twilight, and then after September you could go into the twilight zone to
I thought we were already there. I thought we were already there, Bob. I thought we were already in the twilight zone. Hey, so let me ask you. So copper, all right, we're at or near record highs. Is that going to continue, or is this just going to crash along with everything else?
Don't just survive, thrive. The Financial Survival Network.
Fury Gold Mines is a Canada-focused exploration and development company committed to aggressively growing its scalable, high-grade gold assets with major drill campaigns planned across its 3.5 million ounce portfolio. Fury is led by a management team of proven explorers and developers with a track record of success in advancing and financing project development. Fury Gold Mines is well positioned to create value for investors with low-risk development growth and the potential for a new major discovery. Fury Gold Mines trades on the TSX and NYSE American under the ticker FURY. To learn more, go to furygoldmines.com. That's furygoldmines.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
No, we're getting technical excesses on that one. Highest excesses, let's see now, since there were two peaks for commodities, 2008, remember crude at $147.
Oh, yes.
And then the peak for precious metals and base metals in 2011. So on copper, on just a simple weekly RSI, you're up to a reading the highest since the high with the 2007-2008 fabulous bull market. So, and then the other day we got what we call a trifecta sell on corn, which has been going straight up, and as we all know, it's really the big ag crop. And by a trifecta, we got upside exhaustions on the daily, the weekly, and the monthly on it. And the last time was a long time ago. So there is a powerful wind blowing about inflation in tangible assets. And I'm staying with the view that the really big action is inflation in financial assets. So where your perma bulls and commodities have come out with this is a super cycle for commodities. Hell, we've been in a super cycle for stocks and bonds, the likes of which haven't been seen since 1929. So this is where the old history comes in, Kerry, is that 1929 is a good example because there was a huge bubble in commodities around the world in 1920. And then that one was almost a decade to where stocks peaked. And that showed up in the first great bubble, the 1720 South Sea bubble, where there was a war and a huge commodity blowout up until 1710, 1711. So there's been a long pattern that you have a really big boom in commodities, crash, and then out of the ashes comes the phoenix of stock and bond speculation, and this has been on. And you've got, like, for example, in Germany with the 10-year note getting to almost minus 1% nominal. It never happened before. So what this is you flip it and look the other side, and that's inflation and bond price without precedent. So there's no question in my mind that we are in the super cycle for financial assets, such as 1929 or 1720 or any of the four in between. 1825 was a huge global financial bubble and then crash. So the pattern is that once the financial mania is over, it gets hit, you have a liquidity crisis, and then in each case, this is now the sixth time, everything deflated. It's hard to comprehend now when a lot of the inflationists from the 1970s are saying this is it, you got a reckless Fed. Well, the Fed, there's no time in my mind when the Fed has not been reckless because it has strange theories. But the fascinating thing for a financial historian or researcher is when you have everybody speculating in commodities, like 1980 was a huge peak in commodities. And then you had the hard crash. And then Chairman Volcker at the Fed then got the blame for ending inflation. But if you take a look at money supply figures like M2 or something like that, there was no change in the growth rate. It kept growing. Commodities crashed. And then in 1982 is when this new era of inflation and financial assets started. So this is, to my mind, this is a classic financial bubble. This has action over the last couple of years, has more in common with 1929. And now 2007 was a very good bubble. We did well on that one, but it wasn't as complete as 1929. Whereas now, things I'm looking at, this has a lot of 1929 to it. For example, after the commodity hit in after 1920, the Fed was paralyzed about deflation. There wasn't not enough inflation, so they kept their policy easy, not understanding that the world was going into inflation in stocks and bonds until it was too late in 1929. Now, we know that for the last decade, the Fed has been concerned that there was not enough inflation, meaning CPI inflation, and keeping far too accommodative policies. And of course, what happens is the public decides it's going to speculate in stocks and bonds, which it has. And then on the final business cycle, within an era of financial asset inflation, you do get a boom in commodities and you do get a boom in residential real estate and that sort of stuff. So I'm thinking here, we discussed lumber. It is now generating technical excesses on the upside. Copper, definitely. Corn, yes. So we're getting what we think is concluding action on some of the hottest commodities, the ones that trade the biggest, like corn and copper. They're important. So we're actually advising people to lighten up on equities, lighten up on low-grade, junk bonds, that sort of stuff, where people have been forced to reach for yield. And I think we're going to have a sniff of credit concerns begin to appear, maybe late September sometime.
Just a sniff? Just a sniff, Bob?
the first whiff back then. And now here's another thing, Kerry. You know, they're talking about all the liquidity out there that the Fed is providing, and then there's all this liquidity bidding up residential house prices and all the liquidity building up commodities. But in the main, it's not liquidity because they're very aggressive traders that are leveraged up. So what appears to be liquidity is borrowed money buying the hot items. And actually today there was, earlier in the trade, very interesting hits against lumber and against corn, just wham, and against copper. So we looked around and couldn't see any news related to it. It was just at this moment a hiccup. But this is ending action in here. Now, what about gold and silver? Well, they're rallying with the weaker dollar recently. And then, Kerry, as you know, historically, we've done a lot of work on the senior currency in the midst of a financial mania. And one of the things that is common to each of the post-bubble contraction, that senior currency gets chronically firm against most other currencies and most other commodities, and then I like to say for most of the time. So how can you sit here and look at the Fed, which has declared itself crazy, and they'd added the crazy lady Yellen to the Treasury, so they're all going to be crazy. But what happens is that in the financial mania, there's a lot of debt underwritten, and whereas the stock market gets the headlines, but underneath it, the credit markets are just as big and just as powerful. So, but with most of the debt in the bubble written in New York, the financial capital, it used to be London, and it used to be sterling, but now it's dollars. So then when the contraction comes in, people stop borrowing money and they start trying to pay it back, in which case you have the problem of servicing debt into the U.S. dollar, into New York, where the dollar is firming, mainly because even if, say, 60% of the debt on the bubble is due and payable in New York, that's the majority, and it represents a huge short position in dollars. And you can go back all the way to the 1550s when Gresham was one of the great traders in history, and the money market then was in Antwerp. So he also was trading his own account there, but he was also ended up being agent for Elizabeth I. And this is where you got the letters written by Gresham, Thomas Gresham, advising the Queen that it's impossible to owe a whole lot of money in a weak pound against a strong guilder. So this is the start of what is today called Gresham's Law, where bad money forces out good money. And he didn't invent it. It was a later economist in about 1900 came up with Gresham's Law. But at any rate, the instruction from Gresham is the problem of owing money in from a soft currency into a hard currency. So this is then what has forced previous long contractions is that the debt has to be serviced in senior currency units, and the senior currency is still the dollar. And looking at the dollar here, we've found that important lows in the past on the DX take about 4 months from the initial hit and oversold, and then trading up and down for about 4 months. And this is now having a good test of the low earlier in the year. So we're out to around 4 months when this base building, if it's going to conclude, is likely to do it. And the measure that we use to conclude that the base building in the DX is completed is when the DX rises above the 20-week exponential moving average, which it's underneath it now. So that's just one step we're looking for. That would conclude the base. and then you'd have to rally up to something at 94 to set the uptrend. And if you take a look in the contractions in 2008 and 2001, the U.S. dollar did rally at the times when there was the greatest liquidity problems in whatever the hot games were. So this is where we're a little cautious on the gold stocks in here. And we work gold on the real or deflated price of gold, where you divide it by the CPI rate of inflation. And that one has a long and consistent history of gold's real price going down in a financial mania, whether it was 1929 or 1720, and then it goes up. So for some reason or other, gold's deflated price had an important low in 2018, which was our buy on the gold sector for a multi-year move. And then in last July, everything in the sector became very overbought. So we had then advised both traders and investors to take some money off the table in the precious metal sector. And then as it turned out, the real price corrected, and it's still weak because you got the financial party back on. So what is likely is once this great speculation in the lumber and copper and corn and all these sort of things ends, and it will with a post-bubble contraction. So what happens there, and this may sound convoluted, but it's the way it works, gold's real price will go up, which then means that the cost of mining gold begin to improve. You don't have to have it at 1,700 or 2,000 or 10,000. You just have to have it doing well relative to the costs of mining. And this is where the real price comes in. And with the previous post-bubble contractions like the 1930s, you eventually got into an incredible bull market for gold stocks and gold mining when you were in the depression for most anything else. And I can give you some examples there. Homestake was the senior producer then. And of course, it didn't really fly with the 1929 bubble, but the stock went up. But it didn't do so well because their costs were going up. So profitability was disappearing. And then with the bust, and you had costs of most everything going down, Homestake started to make some money. So by the end of 1932, and Roosevelt didn't begin to fool around with the price of gold until March of 1933. So by the end of 32, Homestake stock was up something like 130%. And of interest is that their earnings were up about that percentage as well, with no change in price of gold. It was still $20.67 an ounce. But they started to come back in where their profit margins improved. And then Homestake stock got up to something like $65. And you could have bought it in 1930-31 at, let's say, $9. And then in those days, gold miners paid out everything by way of dividend. So in the mid-1930s, you not only had a stock that went from $9 to into the 60s, but you had it paying $4.50 a share dividend. So the amount of money that gold mining was making in a post-bubble contraction is the way it works. So this one now, you're going to go, well, actually on our buy in the golds in 2018, that was November, we noted that quite likely the golds could outperform the S&P. So if you take the GDXJ and compare it to the S&P to last 1st of August, the gold's GDXJ had outperformed the S&P by 2.2 times. Fabulous. So now, once this correction in the gold sector is over, which may be in the fall, as if we go under pressure for the big market and we get our next buy on it, that would be the same recommendation again, that not only would gold stocks go up, but they would outperform the S&P. and Kerry, you know where this is leading. At some time in the future, more and more fund managers are going to have to be in gold, even though they may not be gold investors, but they're just going to have to be in it because of the performance.
Got to be in it to win it. All right. So
in it to win it. Yeah.
So to answer the question, Bob Hoye is not buying Dogecoin, so don't accuse him of doing that. But he does see something interesting brewing in perhaps a gold-backed cryptocurrency that becomes the world currency, because Lord knows the vicissitudes of the U.S. dollar are kind of driving the global economy insane, and COVID didn't help any either. So, hey, if you got a question for Bob, send me an email, kl@kerrylutz.com. We'll get an answer from him for you. And make sure you go over to our site, financialsurvivalnetwork.com. Sign up for our free newsletter. Bob, it's always a pleasure. It's always informative. I learned so much from you. Keep up the great work. We'll talk to you again real soon.
Anytime, Kerry. Always fun to be with you. Yep, indeed.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.